Hey everyone, today we're talking about becoming diversified with asset allocation. My name is Isaiah Goodman, Chief Financial Advocate at Becoming Financial. You might have heard the term before, asset allocation or diversification. What the heck does it mean? Today I kind of wanted to talk to you about some ideas, examples for how you can invest and become diversified and allocate your assets in a way that you're not too risky in one or the other. So first example is actually an analogy related to gambling. Roulette. So I wanted you to think about a roulette table. You've got all the different colors and numbers and everything on the wheel. Well, the odds are it's about 47.3% that you'll land on red, or 47.3% that you'll land on black. And you really don't have to worry about green. There's only one slot, right? 47.3% that you'll land on an odd number. Same thing for an even number. Don't really worry about zero. So the odds are if you bet on one of those two majors, you're probably going to land on that, right? Every once in a while, you kind of have to accept that the ball might land on zero or the green. But for the most part, if you bet red or black, even or odd, those are going to be your main winners. That's kind of how it is with the stock market. If you try to guess or bet on the really, really slim example that could make it big, most of the time you're probably not going to win. But if you guess on the more tried and true things that are a little bit more predictable, that's where you're going to have more consistency. So what I want to talk about today was, what are those stocks? How do those things work? So first, of course, you've got different types of assets, stocks versus bonds. Commodities are things like gold and silver. You've got real estate and even just cash. So that's one part of it, is what types of assets are you investing in? And then where are you investing? So first one is large cap. So large cap capitalization means large market capitalization. So this is things like Amazon, companies like Google, Apple, the biggest companies in the world. That means they have a large market capitalization. Typically, they're going to be the least volatile. They're going to have the slowest sort of ups and downs, but they're obviously very big because they've got the largest market cap. That means they've got the most number of shares and probably the highest stock prices. Next, mid-cap. So these are companies that are big, they're growing, but maybe they're not quite the biggest in the world. And then, of course, small cap. These are companies that are doing well. They're public companies. They have stocks, but they're just a little bit smaller. Maybe they're not trading as frequently every single day. You want to have a good mix. Typically, where you've seen the largest growth and highest return is small and mid-cap, because you're kind of taking a gamble or a bet on a smaller company as it hits it big. But more tried and true, like a Coca-Cola, some company that's been around for years and years, those might give you better dividend returns year over year. So you want to have a good mix of large, mid, and small cap. Again, typically those are just US stocks. Then you want to get into some international exposure. So there's a couple different groups with international. We're not going to go into everything, but you've got developed. So you've got international exposure in what they call developed countries. So you're looking at some of the bigger countries around the world that they've had companies that might be even older than the US, and you're trying to invest in those. And then you've got emerging. So you've got companies in countries that are growing, they're up and coming, they're kind of getting things together. Those, again, might be an opportunity to have a bigger return, because if you're investing in a smaller company in a smaller country, that could really hit it big over time. So again, asset allocation, sort of your pieces of the pie, you want to be invested in a little bit in all of these. Next, you've got things like US bonds, international bonds. We've talked about the difference between stocks and bonds, but the only difference there is you've got a bond with a different country or a different company in a different part of the world. Then lastly, we've got things like commodities, real estate, and cash. Commodities, you can invest in things like silver or gold. You can even invest in things like wheat, barley, just commodities, things that people need. They have prices that go up and down based on supply and demand. So you can invest in that and benefit. Things like gasoline, etc. All of those have prices that you can invest in. Real estate, it's a little bit more complicated, but you can invest in companies that own real estate and have returns. And then lastly, cash. Some people have cash as a good part of their portfolio because they want to save the money. They want to be able to buy into the stock market at any point. But it obviously reduces risk because cash shouldn't really change in terms of its value or price too much. So that's what it means when you're thinking of a diversified portfolio, asset allocation. You might have heard the term, don't put all of your eggs in one basket. That's what it's coming from. It means don't go buy all of the shares of Amazon and bet your entire retirement on just one company. Nothing against you, Amazon. But you want to invest in different types of industries, technology, retail, food. You want to be able to sort of take the ups and downs of different parts of the country, the different parts of the world, and be able to grow your portfolio a little bit more diversified, less risk over time.